Good afternoon, grade 12s. I'm Mrs. Wessels of Unisi High School in Bloemfontein. We did balance sheets and we did income statements and adjustments, but today I'm going to do a normal cash flow statement with you, and I'm going to show you all the tricks that I usually teach the learners on the cash flow statement. I'm using an activity from the new era again. Thank you to the new era. And I'm going to do an activity from there. Okay, but first, I've got the cash flow statement in front of me. It is only the format, and I want you to know the format. I want you to study the format out of your head, because sometimes they don't ask the whole cash flow statement, and if you don't know what to do, then you struggle. The first one is cash flow from operating activities on top. Then in the middle, we've got cash flow from investing activities. And then at the bottom, we've got cash flow from financing activities. The first thing is that you must understand what the meaning of this is. Operating activities is your day-to-day things that you do from day to day. The business buy goods, the business sell goods, you pay your creditors, you receive money from your debtors, you bought some trading stock, etc., etc. And that is your day-to-day transactions. Investing is, okay, let me leave investing first. Financing activities. Where does the money came from? And the money came from loans and shares. So I'm going to write the loans and shares. So the financing activities part is loans and shares. Okay, now, if we've got the money, where are we going to invest the money in? And we invest the money in, or what do you do with the money? Not day-to-day transactions, other things that you do with the money, and that will be your investing activities. We invest in fixed assets. And we invest in a fixed deposit. So you can see that the middle part of your cash flow statement is basically fixed. So this is that part there. And this is your part from financing activities. Okay, please know your format. First you write cash generated from operations. That is note number 1. That was already there. Utilized means if the answer is in brackets, then it's utilized, not generated. So when the answer is in brackets, it means that money go out, not come in. So you cannot generate that money, but you utilize, you basically use the money. Then you've got interest paid. If there is interest received and interest income, you will show it there. I'm just going to write it down. It will be interest received. And remember, those two differ from your note number 1. I've got note number 1 here, where we say profit before tax plus or adjustments for depreciation. So we add the depreciation. Why do we add depreciation? Because depreciation is not money. And we didn't pay out any money, so we must add it. Then we add interest expense. Because we want to show the interest on the cash flow statement itself, but there we show paid. And then we minus interest income, so that we can show interest received on the cash flow statement again. So please, you must know that those are related. Interest paid, interest received, that is money. It is related to interest expense and interest income, that we plus and minus in note number 1. I'm going back to my cash flow statement. Then you've got dividends paid and tax paid. Dividends paid. And we've got tax paid, and that is, or taxation, sometimes they say taxation, and that gives us note number 3 and note number 4. So where is note number 2? Note number 2 is your cash. Okay, please know your format. Then purchase of fixed assets and also proceeds. Proceeds is when you receive money from sale of fixed asset or fixed assets. And then we've got the fixed deposit, increase or decrease in your fixed deposit. Just make sure if there is an increase, so the fixed deposit become more, then it's money out. But when it mature, it's money in. Your fixed deposit or your investment, remember it is the same as your investment. That is the middle part, which is fixed assets and fixed deposit. Then you've got proceeds from shares issued. That is when we issue more shares, so it's money coming in. And then buy back shares. That is when money goes out. And then whatever happens in your loan, a decrease in loan is money out because we pay the loan, an increase in loan is money in. Then net change in cash and cash equivalents gives you note number 2, note number 2, and note number 2, and I will come back to that. Please make sure that you know your cash flow statement, that you know exactly what part is operating, what part is investing, and what part is financing, so that you didn't struggle to do that. You must just do the work, do your calculations, know exactly what to do. For note number 1, we already fill in depreciation plus interest expense minus interest income, and that equals to operating profit before changes in working capital. What is your changes in working capital? A decrease or an increase in inventory, whatever happens there. Increase or decrease in receivables, that is your debtors, and an increase or a decrease in your payables, and that is your creditors, and we will see later what happens there. And that answer is cash generated from operations or utilized, and that will go to your cash flow statement. Note number 2 is very easy. That is the cash and cash equivalents note, and they will not ask you this note because it's just it's too easy. The only thing that you must do is put in last year and this year. Then your dividends paid and your taxation paid. When you do your dividends, you work with shareholders for dividends. Okay, so when you can see that shareholders for dividends has their own note. So whenever we work there with the creditors or the payables, we ignore shareholders for dividends. We ignore SARS because SARS also have their own note. So if you're busy with your creditors and your debtors, ignore SARS and ignore the shareholders. Because when you do taxation, that is your SARS income tax. Income tax that you are working there with. Income tax. Okay. I think we must start working. I've got an activity from New Era, like I said, and that is task 3.49. 3.49 from the New Era in BSU Pty Limited. Prepare the notes to the balance sheet on the 31st of March 2014 for ordinary share capital and retained income. We did a lot of notes. I am going to do this one quickly. Because we're not used to this note being with the cash flow statement, but it can happen like year. Then prepare the cash flow statement for the year. I'm going to do it with all the notes, and then in the next lesson I will show you what you can do if they don't ask you all the notes. Okay, for the information here, we must go to number 6, information number 6, and that is there at the bottom, share capital. The authorized share capital comprises 400,000 ordinary shares. So authorized is 400,000 ordinary shares. Then, okay, our accounting year is, I think they mentioned it at the beginning, on the 31st of March is the end of the year. So that gives us the 1st of April 2013 until the 31st of March 2014. 14. There is our accounting period. There is our accounting period. On the 31st of March 2013, there were 240,000 original shares in issue. That is your balance. That is basically your balance there. And we are going to start our note with that balance. And that will give us 240,000 ordinary shares in issue. Ordinary shares in issue, beginning of the year. Okay, now you will see that they don't give you an amount. They don't give you an amount. So you must go back to your balance sheet given to you, and there is your ordinary share capital, starting with 120,000 at the beginning of the year. And of course, it must end with 211,600. It must end with 211,600, and we will see that we get there. Okay, more information. Sorry, there is the 120,000 and the 211,600. On the 31st of May, can you see now they first buy back? They first bought back 12,000 shares. We are used to first issue new shares and then buy back, but now they first buy back. 20,000 ordinary shares bought back. And remember, they mention 90 cents per share. They say at a price of 90 cents per share, and that 90 cent we are not going to use. We need the average price. And because we buy back before we issue shares, you take the 120,000, that is the money, the 120,000, that is the money, and you divided it by the shares, which is 240,000. Only that one there and that one there. You haven't got anything extra, and that gives you 0.50. That gives you 50 cents. So this one will be at 50 cents per share. So the 12,000 will be at 50 cents per share, and that gives you 6,000 Rand in brackets. But what about the other 40 cents? Because you've got 90 cents there, and we split the 90 cents between 50 cents in the ordinary share capital. And where does the 40 cents go? To retained income. Retained income. Remember that. Okay, so we've got the retained income there. The balance at the beginning of the year, was, there's your retained income. 54,400, that was beginning of the year. The balance at the end of the year must be 121,200. 121,200. That is the balance at the end of the year. And then we can go back to the information there. Okay, we want to buy back. Okay, first it is net profit. Net profit after tax. Remember, after tax. Why after tax? Because in the retained income note, there's no place for tax. That's why it's always after tax. And then buyback shares. We've got buyback shares there. And we show the 12,000 shares times the 40 cents. The 12,000 shares times the 40 cents. And that will give us 12,000 times the 40 cents. That gives us 4,800 Rand. And that will be the buyback shares on this side in the retained income. So the 50 cents is on top. There's the 50 cents. There's the 40 cents for the 12,000 that we bought back. The last information there, the company issued 122,000 ordinary shares. That was issued during the year, issued at 80 cents. And that gives you 122,000 times 80 cents, and that gives us 97,600. Now we check on the left hand side. We've got 240,000 minus the 12 plus the 122,000. That gives us 350,000. On that side, we've got 350,000 shares. in issue at the end of the year. Ordinary shares in issue at the end of the year, and on that side we've got 120,000 rand minus 6,000 plus 97,600, and that gives us 211,600, and that is exactly what we were looking for. So that is the correct answer. If we go to the retained income, we need to use now for your cash flow statement, you are going to show this 6,000 as money in, and you're going to show this 97,600 as money out, because that's exactly what happened. We buy back shares for 6,000 rand. That is money out. So the 6,000 rand is buyback shares, 6,000 there in brackets. And the proceeds from shares issued, is 97,600. Oh, sorry. I'm going to take that one out. That is only from your shareholders' ordinary share capital. You mustn't forget about the retained income. There's two ways to do this. You can say 6,000 from the ordinary share capital and 4,800 from the retained income. Okay, so that gives us 6,000 plus 4,800. That gives us I think there's something, just give me a moment. 6,000, the 12,000 was there. Okay. 6,000 plus 4,800, but that amount is not correct. Let me quickly see. We buy back shares for, oh, there's a problem there. I'm so sorry, that was 95 cents. That was 95 cents. Okay, let's quickly see again. So we go back to retained income. We go back there. 95. 95 we split between 50 and 45 cents. Okay, are you with me? Then we go back there and we make it 45 cents. 45 cents. And that gives us 12,000 times 45 cents, and that gives us 5,400. Okay, 5,400. I'm back in my cash flow statement. Remember, this is retained income. Now I'm back in my cash flow statement, and that one must be 5,400. So that gives you 6,000 plus 5,400. That gives you 11,400 rand. Remember, you can add the two amounts together. That gives you 11,400 rand. Or you can just straight say it was 12,000 shares times 95 cents. You can do it straight. Because remember, in the two notes we split it. In the two notes we must split it. But in the cash flow statement, it's only about money. So you can say 12,000 times 95 cents. That gives you 11,400. And there's your 11,400 rand. 11,400 rand. One of the two. I prefer this one. Because it is, they gave you the 95 cents and you've got the 12,000, but we cannot always use it because sometimes they don't give us that 95 cents. Then you must take the 6,000 from your ordinary share capital, and you must take the 5,400 from your retained income. Okay, so we are done. So we underline the 6,000 and the 5,400 there because we must use both of them. Information number 1 is going, it's very nice. Information number 1 give us the interim dividends of 22,800. Remember, I'm in my retained income note. So paid is your interim dividend, and that is 22,800. And now they gave us a question mark at the final dividends. Where must you go? You go to your information and that one there, sorry, on top there. Go to your information and your shareholders for dividends at the end of the year. That is your final dividends. Please make sure that you know this, because sometimes they're not going to give you the final dividend, so you must know that your final dividend is your shareholders for dividends at the end of the year. 49 there, 22,800 plus 49,000, that gives us 71,800 in brackets. Okay, and we are still looking for the net profit after tax. Information number 2, income tax for the year per income statement. At 20% of the net profit before tax amounted to 56,000. Okay, in your income statement, you've got net profit before tax. Then you've got your tax there, and that equals to 28% of the above amount. And you minus that tax, and that gives you net profit after tax. Okay, are you with me? That is in your income statement. Now, the only thing that's given to us is the 56,000 rand. So only the income tax is given to us. Can you see there? So a normal maths calculation, you just say that 28% of X, what is X? Profit before tax, gives you 56,000. X equal to 56,000 times 100 divided by 28. So X equals to 56,000 times 100 divided by 28. That gives you 200,000. But that's not what we are looking for in retained income. We are looking for after tax. So we say 200,000 minus the 56,000. 200,000 minus the 56,000, and that gives us 144,000 rand. Okay, let's quickly see if our retained income amount is the same as that we've got in the books. So we start with 54400, we add 144,000, 144,000, we minus 5,400, we minus 71,800, and that gives us 121,200, and that is 100% correct. 100% correct. Okay. Cash flow statement. Let's go on with the information there. Let's use what we've got. We've got the profit before tax. We've got the profit before tax. That was 200,000. We just calculate that one. So profit before tax was 200,000. The tax we are going to use in the note for SARS income tax. Let's quickly read down this note. You start with balance beginning of the year. Then you say amount in the income statement. That was the 56,000 that we just saw there. That's always in brackets. The 56,000 is always in brackets. And then we say balance at the end of the year. Balance at the end of the year. Remember I said we must go to source income tax. So for source income tax, we must go up there. And you will see that source was as a creditor in the beginning of the year. And source is a debtor at the end of the year. Okay. So that means that we owe source in the beginning of the year 14,000 rand. Did we pay them? Yes. They start as a creditor and we must pay that amount that we owe from last year. Then SARS end as a debtor. What is the meaning of a debtor? SARS owe us. SARS owe us money. So why did they owe us money? Because we already paid 2,500 Rand too much. We paid 2,500 Rand too much. That gives us 14,000, 56,000, 2,500. I know all of them are minuses, but I just add all of them and I put the 72,500 in brackets. I put the 72,500 in brackets. Okay, for dividends, remember we've got the dividends amount in the retained income. It was given to us, not really given, but we work it out as 71,800. That is the total dividends for the year. So the balance at the beginning of the year. Then we've got amount per financial statements. And then we've got balance at the end of the year. The 71,800 come there, always in brackets. That amount is always in brackets because that was the amount that we're supposed to pay. Then we've got the shareholders for dividends there in the beginning of the year, 36,000. That is the final dividend of last year. This is the final dividend of last year. Did we pay this year? Yes, we did. The 49,000 is the final dividend of this year. What is the 71,800? The interim plus the final. We didn't pay the 49,000 because we owe them. That is the final dividend. So our calculation will show 49,000 minus 71,800 minus 36,000. So we paid 58,800. We paid 58,800 and then can I ask you, what did we pay? What did we pay? We pay the final dividend of last year, this one, and we paid the interim dividend. So we paid the 36,000, that was the final dividend of last year, and the interim dividend, there it is, given to us as 22,800 plus 22,800. So you can check yourself by saying, I paid the final dividend that I was declared at the end of last year. I paid the interim dividend, and that gives me 58,800. Let's take this to the cash flow statement. We can take it to the cash flow statement. For dividends paid, 58,800, 58,800, and for tax paid, 72,500. 72,500. Okay, we are done with information number 1. We are done with information number 2. I just want to show you that you can also use, before I go on, I want to use this appropriation account and quickly show you a few things. Remember we used the 28% and the, okay, let me just write it there. We used the 28%. So before tax, it was 200,000. And after tax, it was 144,000. Okay? But you can also use the appropriation account. Let's quickly go to the appropriation account. If you look at your appropriation account, profit and loss is there. Profit and loss is there. We've got income tax on this side. Remember, the income tax is there in information number 2. 56,000. We've got dividends on ordinary shares, which is the 71,800, okay? Then we've got our retained income account there, retained income account there. The balance for the retained income was at the beginning of the year 54,400. Then we buy back shares, so there's basically a bank CPJ. We buy back shares for 5,400. Do you remember? That was the buyback shares in that note there. 5,400. There it is, 5,400. Then we have this come to retained income. This go to retained income. This is my, this is basically my unknown amount, but let me just put the retained income appropriation account, the one there. And then the new balance at the end of the day is a balance of 121,200. I know it's a long story now, but maybe sometimes you just use these two accounts to calculate whatever you must calculate. Okay, I'm going to start on the debit side. 5,400 plus 121,200. That is the end balance, gives me 126,600. 126,600 minus 54,400, that was the balance at the beginning of the year, that gives me 72,200. 72,200. If I take the 72,200 there and I add this side of the appropriation account and I say plus 71,800 plus 56,000, it gives me 200,000 rand. And what is the 200,000? It is your profit before tax. So it's just another way to do this. And I promise you, you can use the appropriation account to calculate. If they don't give you the income tax, you use your appropriation account. If they don't give you the dividends, you use your appropriation account, and also to calculate your profit before tax. Okay, information number 3. Information number 3, equipment was sold at book value with a cost price of 18 and accumulated depreciation of 11,000, and depreciation for the year per income statement is 27,000. What are you going to do with that 27,000? The first thing that you're going to do, you're going to put it in your note number 1, where we add depreciation. Why do we add depreciation? Because it's not money. So we add 27,000 rand there. And now we need to know proceeds from sale of fixed assets and purchase of fixed assets. What I'm going to do now is another trick. I basically use note number 3. I basically use note number 3 of your balance sheet. And I write there fixed assets. Fixed assets. Okay. And I say carrying value beginning of the year plus additions at cost minus disposal, and remember your disposal is most of the time at carrying value, minus your depreciation for the year, and that equals to carrying value end of the year. Okay. The depreciation is 27,000, and remember there we minus it because it's minus depreciation. Now you go to your balance sheet information, what you can see there, and you will see there is your fixed assets. There's your fixed assets, starting with 211,000 on top. Okay, now you can ask me, how do I know that it's carrying value? Because they don't give it to you at cost in your balance sheet, it is carrying value. And it ends with 296,000. Now there's two missing figures. The first one we are going to solve with information number 3, where they say equipment was sold at book value. 18 was the cost price, 11 was the accumulated depreciation. 18,000 minus 11,000 gives me 7,000 rand in brackets, and there you can solve the additions. There you can calculate the additions that you bought only with note number 3. Please use all these tricks. Use all of them because it helps you a lot. I normally start at the bottom and I will say 296 0, 0, 0. Then I add whatever was subtracted. So I add the 27,000, I add the 7,000, and I minus the 211,000, and that gives me 119,000 that was bought. 119,000 fixed assets bought. Now we've got enough information. We already put that one in note number 1. That one we are going to put in the cash flow statement, and that one we are going to put in the cash flow statement. So in our cash flow statement, we were looking for purchase of fixed assets. Purchase of fixed assets, 119,000. 119,000. But remember, now it's money out. In your note, it's more fixed assets. In your cash flow statement, it's money out. For this disposal, it's less fixed assets, but there it's money in. So the 7,000 is money in there. So we are done with information 3 and 4 that help us to solve all that things there. And then number 5, Imbizo made payments of 228 per month to Star Bank to cover interest and loan repayments. Interest is capitalized to the loan. Okay, where's the loan? Okay, let me see, where is the loan? There is our loan from Star Bank. I'm going to open an account for the loan, just to show you how easy it is if you take that loan and you put it in a T account. So there is my loan, Star Bank. Remember, loan is a minus plus because it's a liability. It's a minus plus because it is a liability. I've got a balance at the beginning of the year brought down, and that balance was 80,000. Interest was capitalized. Interest on loan was capitalized. So that is the amount that I'm looking for. The payments that was made was 22, what did I say there? 2280 per month to cover the loan and the interest. So that gives you 2280 times 12. So we paid 2280 times 12. So we paid back 27360. We paid back 27360 on our loan. 27360. The balance at the end of the year carried down is 67,000. And now you do the same. You use the debit side. 27360. 27360 plus 67,000 gives us 94360. 94360. 94360 minus the 80,000 gives us interest on capital of 14360. Before I do something with it, I just want to show you this amount, this bank amount. Remember, we are busy with a cash flow statement. So that amount of 27360 that was paid, this amount was paid. And remember, in your cash flow statement, we want to show all the money that goes out. First, you pay interest. And your interest amount is 14360. Then you pay on the loan itself, loan repayment. So if you take the 27360, and you minus the 14360, it gives you 13,000. So we paid back on our loan 13,000 rand. And that you can see, because that is the difference between the balance at the beginning of the year and the balance at the end of the year. So that equals to 80,000 minus 67,000. 80,000 minus 67,000. With this information, we must go to the cash flow statement. First, the interest, 14360 in note number 1. Interest expense, 14360. Then Okay, there's a rule. The rules say, look at this. The rule said, if the interest is capitalized, it's always paid. If interest on loan is capitalized, it is always paid. Why did I say that? Because when you pay money, you first pay interest. So the moment that you put the 14360 at the bottom, you put the 14360 for interest paid, 14360. 143, because it is the same amount. When is it not the same amount? When there's accrued expenses for rent. For interest. Okay, there wasn't an interest received and an interest income there, but let's quickly go to the payment of the loan. The loan payment, there's a decrease. There's a decrease in the loan. And remember, that decrease in the loan was only 13,000 Rand that we paid. Only 13,000 Rand that we paid, because it's the difference between 80,000 and 67,000. Okay, I think we must finish note number 1. What do we need? We must calculate. So we say 200,000 plus 27,000 plus 14360. That gives us 241,360. 241,360. Okay, you go to inventories and you just compare those two amounts with each other. You just compare those two amounts, and that gives you a decrease or an increase in inventories. A decrease. What is the meaning of a decrease in inventories? That there is money in, because we sold our stock. So the difference there is between, it's not easy to do this calculations when you're busy. I just want to show you, minus 91,200, that gives you 116,000 minus 91,200, and that gives you 24,800, money coming in. 24,800 positive, because the money comes in. You cannot use this trade and other receivables, and you cannot use this trade and other payables, because there's notes for them. So we go to the notes and you ignore source. So you basically work with those 4 amounts there. You work with those 4 amounts there. Okay, that gives us a decrease. That is a decrease in our receivables. There's a decrease in our receivables. The amount is 27,000 on the one side, and the other side is 10,500. So if you say 27,000 minus 10,500, that gives us 16,500. That's also money in, because remember, if there's a decrease in your debtors, it means that they pay you and you receive money. Then for the payables, we must take all of those into consideration. Remember, ignore source, ignore shareholders, ignore accrued expenses when it has to do with your interest, but otherwise you must take that into consideration. There's a decrease in payables, meaning that we paid our creditors, so that will be in brackets. On the one side, I've got 69,000 plus 7,000, so that gives me 76,000 on the one side, and on the other side, 39,700 plus 1,500, that gives me 41,200 minus 41,200. So that gives you 76,000 minus 41,200. So that gives us 34,800. 34,800. But that is money out because we paid our creditors. Now we say 24,800 plus 16,500 minus 34,800. That gives us 6,500 on top. Changes in working capital plus 241,360 and that gives us 247860. 247860, and that goes to the top of your cash flow statement, 247860. The only thing that I didn't do yet is note number 2. Let's quickly go to note number 2. Cash and cash equivalents. Nothing is given to you. The bank was not in an overdraft. Where will you see the overdraft? You will see the overdraft there at the current liabilities. The bank is not in an overdraft. So 2013 is last year, 2014 is this year, and our cash and cash equivalents change from 7,400 to 4,800. So what is 4,800? 4,800 minus 7,400. So there was 33,400 money coming in. And remember, if your cash flow statement balance, this must be your net change at the end of the year in your cash flow statement right there. Okay, where is it now? There it is, right there. Okay, I think we are done with the information, so I'm going to quickly finish off the cash flow statement. Let's see what we must still do. On top, the top part, 247,860. 247,860 plus the 14360. No. In brackets, it's money out. It's money out. Paid mean it's money out. So we minus that, minus 14360. We also paid 5,800 on dividends this year, and we also paid 72,500 on tax this year. So that gives us 102,200 on top there. 102,200. 102,200. Let's go to the middle part. We must quickly look at the investment. We must quickly see the investment. There's your investment. There's your investment financial assets. There was an increase. There was an increase in the fixed deposit. So that means money goes out. It's 49,000 minus 19,000. That gives us 30,000. And because it's an increase, the money goes out there. The money goes out there. So that gives us the increase there. Okay. I don't want to come back, so let's quickly check. I always say to the learners, you mustn't leave anything out, but you also mustn't use anything twice. The fixed assets we used. The financial assets, that is the fixed deposit we just used. The inventories we used. Trade and other receivables, remember we used the things there in the note. Cash and cash equivalents we already use. We use the ordinary share capital for the opening and the closing balances. We also use the retained income in our note. We used the loan. The loan became less with 13,000 Rand. And trade and other payables, we go there. On top, there is our note. So we basically use all the information there. The dividends was given. We used that. The income tax we used. The equipment we sold. The depreciation we used. The payback of the loan we used, and we use all the share capital information for the note. So now we are really done with all that information. What do we do with the money? 7,000 Rand coming in. 7,000 Rand, 119,000 going out for new fixed assets, and 30,000 that we paid back on our loan. That gives us 142. No, not on the loan. That we put more money on a fixed deposit. That gives us 142,000. Where does the money came from? 97,600 from shares issued, 11,400 from buyback shares, and 13,000 we paid back on our loan. That gives us 73200. That gives us 73200. Then you say 102,200 from the top. 102,200. You take that one. You take that one. You take that one. And that must give you this one that we put there. 102,200 minus 142,000 minus 142,000 plus 73,200. That gives us 33,400. Do you remember the 33,400 in your note for cash and cash equivalents? That's exactly what we were looking for. So you know that your cash flow statement is 100% correct. What was the cash at the beginning of the year? It was 7,400 in the beginning of the year. And if you take your calculator and you say it's plus 7,400, that gives you the 4,800 that it was at the end of the year. So what did we use in this activity? Specifically, we used the calculation to calculate our net profit before tax. But we can also use the appropriation account to calculate the same 200,000, profit before tax. We use note number 3 to calculate the additions at cost. Additions at cost, remember we bought more, but we use the 190,000 money going out, 7,000 money coming in, depreciation we add in note number 1. We also do the loan. Okay, we split. Remember, we split the 95 cents between 50 cents in the ordinary share capital and 45 cents in retained income. And then we split, or no, not split. We do the loan account to see first to calculate the interest on loan, because we need it for note number 1. And then to see what happened with the 27360. We first pay interest. You first pay interest. That's why we say if interest on loan is capitalized, it is always paid. And then you pay loan repayments, and that 13,000, you can see that is the difference between 80,000 and 67,000. Grade 12s, please use all these tricks. I really hope that it helped you. They can leave out some information. You use your appropriation account. You use your note number 3 to calculate those things, and just do any trick to calculate the missing amounts as quickly as possible so that you can finish your cash flow statement in time. Thank you very much. Next time I'm going to do another cash flow statement, and I will see you then. Bye-bye.